The special significance of the audit of inventories includes inventories often represent the largest current asset of a company. Misstatements of inventories directly affect the cost of goods sold and therefore net income. And management fraud has often involved the fraudulent overstatement of inventory. The auditor's primary objectives in the audit of inventories are substantiate the existence of inventories and the occurrence of transactions affecting cost of goods sold, establish the completeness of the recorded inventories, and verify the cutoff of transactions affecting cost of goods sold. To test existence, completeness, and cutoff, the auditor will perform the following substantive procedures for inventories and cost of goods sold. 1. Obtain a listing of the inventory and reconcile to the detailed ledgers. 2. Evaluate the client's planning of the physical inventory. 3. Observe the taking of the physical inventory and make test counts. And 4. Review the year-end cutoff of purchases and sales transactions. Once the testing of the physical inventory is completed to test existence, completeness, and cutoff, the auditor will perform the following additional substantive procedures. Obtain a copy of the completed physical inventory and test its clerical accuracy and trace the test counts into that listing. 2. Test the pricing of the inventories and evaluate the basis and methods of inventory pricing. The auditor will review the client's plan for the physical inventory in regard to the appropriate date. The date is typically at or near the balance sheet date unless internal control is very effective. Suspending production. I always like to see the client suspend production when they do their physical inventory. Segregating obsolete and defective goods. We want to make sure these are not counted as goods of value. Establishing control over the counting process. Achieving proper cutoff of sales and purchases. And at times, we need to arrange for the service of a specialist to come in to help us with the inventory. For example, if you were doing an inventory of a jewelry store, you would need a specialist to look at the jewelry. The plan should be documented and communicated in form of written instructions to the personnel taking the physical inventory. The client counts and supervises the inventory, not the auditor. The auditors observe the physical inventory to determine that all items are included, that employees comply with their instructions. The auditor should be alert for the inclusion of obsolete and damaged merchandise in the inventory. The auditor should record the numbers of the final receiving and shipping documents issued before inventory counts to ensure proper cutoff. The auditor also makes test counts that they then tie into the final inventory. And the auditor also wants to be sure that the procedures for controlling the tagging of the inventory are followed. In testing the proper cutoff of inventory, the auditor should examine on a test basis the purchase invoices and receiving reports for several days before and after the inventory date. Determine that liability has been recorded for all goods in the inventory. and make sure shipments and purchases are recorded in the proper period. The inventory balance on the client's financial statements is a function of the quantity of inventory on hand and the value of the inventory. While the inventory observation tests the quantity, price testing tests the cost of the inventory. Generally accepted accounting principles require that the inventory be recorded in the financial statements at the lower of cost or market price. Price testing is the verification of the cost that the company paid for the materials, labor, and overhead that goes into the production of inventory. To perform price testing, the auditor selects items from the company's inventory on a test basis and then will trace the cost to the applicable vendor's invoice based on the client's inventory method, FIFO, LIFO, weighted average, etc.